Hello and welcome to Building the Premier Accounting Firm. This is for individuals that would like to have a successful accounting, bookkeeping, and tax business. This show is dedicated to helping accounting professionals confidently and competently offer quality accounting services to get paid what they are worth. Each of the episodes that we have are conversational with tips and tricks on what you can do to address things such as marketing, lead generation, finding the ideal clients, pricing, price strategies, accounting services, value-added services, workflow, practice management, staff training, client onboarding, client relations, retentions, and so much more. Each week, I actually invite various guests, experts to the show to share with us their insights and expertise as to what it is we can be doing to, in fact, have the premier accounting firm in the area, giving you an opportunity to work on your business and have the advice from the experts to do so. I happen to be your host, Roger Connect, President of Universal Accounting Center, and as your host, I've been working with accounting professionals for more than 20 years, helping them actually achieve the various successes that they'd love to have around the world. In doing so, building amazing relationships and friendships, and I'm happy to share these experiences with you, as well as these discussions with the experts. Today, I happen to have a guest on the show that I'm excited to have. That's someone that I'm sure you're going to enjoy. Ian happens to actually be one of the founders of Financial Modeling Institute. He started it back in 2017. He actually oversees the organization, including its strategic direction. Ian is also the founder of Marquee Group, a leading provider of financial modeling training, consulting, and accreditation. Now, over the last 20 years, Ian has taught thousands of business professionals and university students around the world. In fact, Ian is passionate about teaching and brings a hands-on interactive approach to all of his courses that he teaches. Ian, in fact, teaches at Queen's University in Canada and is the recipient of the Instructor of the Year Award in the Master of Finance program at the Smith School of Business. Previously, Ian spent a number of years in the investment banking departments at Citigroup and BMO Capital Markets, and Ian completed his Bachelor's of Commerce with honors, and he actually is an academic with distinction from the University of Manitoba and has attained the Chartered Financial Analyst, CFA designation. So, Ian, a lot to be said there, and welcome to the show.
Thank you, Roger. I am thrilled to be here with you today.
You know, we've just got so much to discuss. I just made so many notes here and have a lot of things that I want to jump into. So as a fellow instructor, one of the things that I wanted to start with is, what is it that you feel makes it a unique person that can actually be kind of that mentor, if you will, to the student body? When you're in a position of teaching, is there something that you feel you bring to that classroom that makes it so that the people can actually learn and enjoy what it is you're teaching?
Oh, I love that. What a great question and a great way to start. Thanks, Roger. Usually people ask me about financial modeling to start. I'm sure we'll get there. But, it's funny. I've been teaching for 20 years. I've probably taught close to 2,000 full days. I think I've taught somewhere between 20 and 30,000 people over the past 20 years. The first book I want to write has nothing to do with the technical skills I teach, like modeling and Excel. The book that I'm writing is about teaching because there's a huge, in our world, your world and my world around accounting and numbers and finance. These are topics that people, by definition, think of instinctively as dry, boring. It's not true, but the instinct is, wow, it's accounting or it's finance. It's probably going to be boring. And people will leave our classes and our sessions and go, wow, that was the most fun. That was the best time I had. So that's really your question. How do we do that? Well, for me, teaching is all about creating energy and, bringing passion and getting people excited about something, a new skill, a new idea, making a light bulb go off in someone's minds that they need to learn is so exciting. And it's, why I think teaching is one of the best things, most fun things you can do. And we all teach. Everyone teaches something, right? You teach your kids, you teach your parents, you teach your friends, your work colleagues, you tutor, you mentor at the office. You might teach a kids team. We're all teaching. And there are skills that make a huge difference between a session being boring and dry, where everyone's on their phone, versus something where they're compelled and loving it. Yeah, and it's about the way you communicate, the way you articulate, the way you bring energy and get people involved. So we spend a lot of time thinking about that.
Yeah, one of the things that I thought you brought there is the energy. Obviously, when we're teaching, we have to instruct with some type of passion that gets the people to feel that this is something they want to learn about. It's what's contagious about the whole experience. So I'm sensing that, and I appreciate that. So let's jump into the financial modeling that we were discussing. For accounting professionals, this might be a term they are familiar with, but really, just in layman terms, what is financial modeling?
Yeah, I love the question. It's a great question. It's evolved. So some people will have a sense for what it is. I'm sure many of your listeners will, but even the notion of the term has evolved. I mean, in theory, at the highest level possible, financial modeling really just means taking something that exists in the real world and creating a virtual representation of that thing in a piece of software. That's it. It could be anything. I mean, I could build, a mechanical financial model to understand elevators in a building. It doesn't matter. I mean, you're creating a virtual representation in a piece of software of something physical. But financial modeling tends to be more specific. Financial modeling, the way we use it in a much more narrow sense, financial modeling means very simply using a spreadsheet. So our software we're narrowing down is not any black box software. When we talk financial modeling, we're typically talking about our software being a spreadsheet, which is usually Excel, doesn't have to be. And what we mean by financial modeling is building a forecast. Forecasting a company or a division or a product line or some sort of a business. Yes, the term financial modeling doesn't sound that specific, but that's what we're meaning. Let's forecast a project, a company, a business of some sort to look into the future.
I love it. So what I like to say about financial modeling and forecasting, as you mentioned, is basically we're taking the history and we're taking the understanding we have, the wisdom being involved with that, and seeing how well we can project out into the future and with confidence foresee what's going to happen weeks, months, and years later. And the beauty of it is the tweaking along the way to say, well, here's what we learned about next month when we realized it and had actuals. How were we off? Why were we off? And doing that analysis to then tweak the forecast accordingly. And it's through that we're able to get a better understanding of our needs financially, like cash flow. What are our needs going to be in the future? Can we grow? Can we afford this? Can we buy that? Can we hire this person? Because these are the ramifications. If we put it into our modeling, if we hire this person, this is what's going to happen to everything else. And this is how it's going to impact. So what are the common pitfalls that oftentimes people have when using financial modeling?
Yeah, right. So first of all, the reason we're huge advocates, and you're absolutely right, we start with some history. Now, if it's a startup business, if one of your clients wanted some help modeling a startup, of course, there would be no history. So we would be forecasting the future by trying to come up with some reasonable assumptions. However, we often use history to try to make decisions about the future. We tell people that the reason why modeling has evolved as a discipline, and it used to be a very specific esoteric skill that just a niche subset of bankers would use. But now everybody needs to have modeling skills because modeling just means building forecasting. And by the way, I would say to your listeners, I know lots of accountants and I know lots of business owners that use accountants. I would say, see if you agree with me, the most important thing that any accountant should want to do if they're running a practice is build really close relationships with their clients so that they have strong relationships and ultimately can be a trusted advisor to their business clients for their lifetime, for the whole career. The life cycle of these businesses will, right? And yet so many accounting firms are focused on the requirements, putting together the annual financial statements, the bookkeeping work, the tax filings. And I know so many small business owners that they won't even look at it much. They'll get it, they'll file it away. It doesn't mean much to them. What a small business owner needs, or a medium-sized business, any business, is assistance with decision-making. And decision-making is based on what the future might entail, not the past, but the future. And that's modeling. So modeling is all about helping understand what the future might look like. Understanding what ifs. What if this changes? What if we do this? What if we do that? What if we get hit by another pandemic? What if supply chains get disrupted? What if our shipments are delayed? What does that do to our earnings, our cash flows, our capital structure, our debt levels in the future? And you asked the pitfalls. Well, I will tell you that it sounds really simple, right? All we're trying to do is say, let's look out for the next 3, 6, 9 months, the next few years into the future. The problem is, and this is why we are seeing a lot of interest and demand, most financial models are a mess. I will tell you, most financial models are a disaster. Most spreadsheet-based tools that people build are inflexible. They're hard to use. They're hard to follow. And as a result, it makes it very difficult for people to make effective decisions. Surely, Roger, you've seen your own share of spreadsheets that make you, want to, scream because you can't understand what's going on. I'm sure it's happened to you. It's happened to everyone who's used a spreadsheet.
Well, one of the things that I've experienced is the forecasts that I've received, and I get them on a yearly basis, and we use them throughout the year. The forecasts that I've done with my clients, the forecasts that I've done internally with my management team, is too often the numbers that they're actually using are not correlated. And what I mean by that is when one is changed, others need to be impacted. Others need to change. And so often what it is they are fixed numbers that they're extrapolating, or they're formulas that they're doing off of too few variables. Correct. And what's happening, if you've got top line revenue, if you increase that by 10%, at some point you've got to see that you need another staff member here or another staff member there, or you need to actually increase inventory based on that level, or cost of goods is going to change simply because of now what you're doing to inventory. All of these things have a correlation, and too often I'm seeing that the forecasts that I look at don't have enough depth as to how the numbers affect one another. That's my experience.
You're right. And so there are a number of words we use to describe a very powerful, effective financial model. And one of them is the word dynamic. And the word dynamic in the context of a financial model means it's integrated, as you described. So changing, increasing revenue will automatically dynamically flow through and increase the variable costs. Fixed costs will stay fixed up until a certain point, until you hit a capacity constraint. But then if you're hitting capacity, because of course you can't increase revenue forever without building up capacity, then you're going to get flagged, you're going to get warned. So certain costs are going to change. It's going to impact your working capital, which will flow through your cash flow statement, and everything is going to dynamically flow through it. And so that needs to happen. So a well-built financial model is dynamic, so that anytime you change any variable, it rolls through. As I always tell to people that a good financial model, as I said earlier, it has to simulate reality. So in real life, if a company is going to grow, there will be impact on their working capital, their capital structure, on their fixed assets. And the model has to simulate that by being dynamic to reflect reality.
I love that word.
And very often, as you said, very often they don't.
Yep, that word dynamic captures exactly what I was trying to communicate. So I think that's amazing. Now I'm going to back up a little bit because I think there's some very important highlight tips here that we need to point out. Sure. First of all, as an accounting professional, yes, we're dealing with the historical, but our role today is truly to provide the business owner with that information that they need so that they can be making more informed business decisions, better informed business decisions. But you brought up the term a trusted advisor. When your relationship with your client has gotten to the point that it needs to, when they actually start asking you what if questions. Right. That was that phrase that I was looking for. And when you said it, I was like, spot on. Because when the client reaches out proactively to say, hey, I'm about to make a decision and I need your input. What if I do this? And all of a sudden now they're getting into this mindset of, okay, if I do this, what are the ramifications of it? Which is in the basic form, the first steps of a financial modeling. It's asking the question. And now you actually then model it and you project it out. And that's where you get into these various models that actually show the variations of what could and couldn't happen. Exactly. And the more dynamic it is, the more reliable it becomes because everything's starting to more easily impact one another. So I love what we're talking about here. This is so good.
And it rolls into a term that you use on your website, which I love, which I hadn't heard it before, which is an accountrepreneur. Is that right?
That's exactly right.
And I think it's a brilliant term because it conveys the notion that as an accountant or someone running an accounting firm, that yes, you could sit and do the bookkeeping and simply prepare the financial statements and tax filings. But I would have to guess that a lot of accountants who do just that probably don't speak to their clients very often. They probably speak to them quarterly or annually. But in a strong client relationship, clients calling you all the time. You are a needed advisor. Anytime they want to make any sort of decision, they want to kind of get your thoughts. And I believe that that's a much more valuable relationship. They're not simply paying your bills every year based on price, but rather based on the value of the relationship. It would be much harder to kind of sever ties based on a strong relationship of someone that offers value. And yeah, and that's what business owners need, is assistance helping thinking through the critical elements. Like, did you think about, yes, you want to grow, but did you think about the fact that you're going to hit a capacity constraint and you're going to have to invest, and how are we going to finance that? And where's that going to come from? And that's going to require doubling your inventory and working capital. And thinking through those elements is key. I always tell people, people often think of, I guess, accounting and finance and financial modeling as the type of careers where people sit in a corner, in a dark corner all by themselves. I actually believe that the most valuable aspect of being in accounting or finance is the ability to tell a story, to have a narrative, to understand a business and think through using the financial statements as our language, to talk and tell a story about what the future could look like. Because we don't know what the future will look like exactly, of course. But what if, the Fed's talking about increasing interest rates? What if interest rates go up by 1%, 2%, 3%, 4% over the next couple of years? Can we handle that? Is that going to put a strain on our interest expense? Will we be able to survive that? What's all sorts of, if cost of debt goes up and so on and so forth, what does that look like then? And that's an important narrative that you want to be able to talk through, and our models give us the framework to do that.
When you're doing these forecasting models, what happens is it empowers the business owner to feel more confident about the decisions they're making, because it's taking more and more of the guess out of it. It's not perfect, but it definitely does help kind of show where maybe the model's going to break or where there's stresses that they weren't foreseeing. And that's one of the things that we're trying to provide here is that insight. And it's moving the accounting from historical to real time to future. Now we're projecting, and that's one of the things that we want to be doing. So here's kind of a transition for us. Many accounting professionals working with business owners have opportunities to now see and participate in some mergers and acquisitions, some M&A type experiences, or maybe the business owner is just in a situation where they're acquiring a business, buying a business that is maybe going to leverage them to that next level. How do you use properly structured financial models to avoid poor acquisitions, some flops?
So a lot in that question. That's a great question. When we are discussing sort of a traditional financial model, we are typically referring to a three-statement financial model, where we're referring to the analysis of one company, one standalone company, and analyzing that business so that we can have a full forecast of their revenues, their costs, their tax, their fixed assets, their capital structure. Merging one company with another company, builds on another layer of complexity. In terms of, there's a whole sub-discipline called merger modeling. But at the end of the day, it comes back to, and you mentioned this earlier, it comes back to some first principles. We strongly believe that if you are going to be able to tell a story about a business and be able to build and by the way, when I'm talking about modeling, I'll use words that are unusual in the worlds of modeling. I'll talk about things like beautiful. A good model has to be beautiful. It has to be aesthetic. It's got to make people say, wow. It's got to look impressive, because if it does, it will be clear. It will be transparent. Another one of the key words we use. So to do that doesn't just happen by itself. That needs planning. It requires very strong planning. We actually walk through in our program a very particular planning process to allow you to build a model of a business. So for instance, in talking about M&A, you talked about a successful M&A transaction. The first and largest risk, you hear sometimes all over the news, people say that most M&A deals fail, right? A lot of M&A deals fail. Well, the main reason that happens is because the buyer has overpaid, okay? If you overpay, it's pretty simple, right? You're a numbers guy. If you pay, let's say $10 million, I'm going to throw a number. Let's say you pay $10 million to buy any asset, and you're paying $10 million to buy a company. The only reason, I always tell people in courses, the only reason you would ever pay a certain number, call it $10 million to buy a business, is because you expect a return on investment. So if you're going to spend $10 million buying something, you expect to get some form of return on investment over time, not just in the first year, but over time. Well, if you pay $10 million and then realize, oops, we're only going to ever realize $20,000 as a return, or whatever it is, we're only going to achieve a 2% return on that money forever, then you've overpaid. You can't recover. So the modeling up the target business and understanding the levers and where cash flow is going to come from is extraordinarily valuable to your client to help them think through, what do I need to think about? And therefore, one of the big reasons people use models is to do valuation work. So if you're helping a client assess an acquisition, then helping them think through the valuation will be key, but that's going to come off the back of a very integrated model of the target company. To say, I think you're overpaying, that may not, you may not achieve a strong return, and it may be a problem.
Yeah, doing the forecasting, you're able to actually forecast the EBITDA and at the same time figure out the return on investment as you're paying that back. So there's things that you can then forecast out that are just beyond the accounting itself. There's other elements that then can come into it. Now, here's the interesting part of this. We're talking about acquiring an existing business with history. Earlier on, when we were talking, you brought up the idea of modeling without any history, a new business. How is that different? I mean, you're dealing now with just presumptions. You're trying to just guess. What are some core elements that you need to be asking when you're actually building a model for a business that doesn't exist yet?
Well, it's an excellent question, and it really depends. So, for instance, imagine you had a gym. Imagine you owned a gym in somewhere in a neighborhood of your city, or you owned a manufacturing facility. Didn't matter, and you wanted to build a second gym. You weren't going to buy. You wanted to build a second one, or you wanted to double the size of your existing gym and put in a lot more equipment, or you wanted to double the size of your manufacturing facility. It didn't matter. We call this an organic growth opportunity. Usually, what happens then is if you had, we call this a subspecialty called expansion modeling or growth modeling, organic growth modeling. So what you'll do is, let's call it company X, and the company could be whatever you want. It could be any industry, any business. Ideally, you should have a model for that business as a standalone business. But if you're looking at making a major decision, some sort of a board-approved decision that you and the rest of your shareholders or your board have agreed to, then in most instances, there will be, I always tell people that there are seven issues that you need to think through with regards to the organic growth. Number one, there's likely going to be a capital spend. You're likely going to have to spend some cash up front on new equipment, on land, on a new building, something. Like there's going to be some capital. There will therefore be then an impact on revenue. So of course, in most instances, when people are looking at organic growth, they're expecting a revenue lift. And that revenue lift will either come because you have increased your volumes, or perhaps because you think you can increase prices, but in some form. But I'm just trying to probe. I want my client to think through this, and I want to say, where's the revenue lift coming from? Now, you've just said it. We don't know. I mean, the future might, but it's not the future shouldn't be as mysterious as some people might think. If you've already owned one business, or if you already have a business and you're looking to double it, should have some reasonable idea, right? I mean, if you have a coffee shop with 2 stools and you want to take over the space next door and add a bunch, you're not going to stay, your revenue won't stay where it is. It should grow. So you should have some ability to understand what revenue could be, at least within ranges, and say there's a base case, there's a best case, there's a worst case. And so and then there's cost. If I open up a second gym facility, well, I need to hire more trainers and front desk staff and more cleaners. Okay, what is that going to, well, I know what I pay them at my existing facility, so I have an idea for what I should have to pay them in a new facility. It will impact working capital. Do I need more inventory? Will that change my receivable picture? Is it going to change my capital? Will I need debt? How am I financing this growth? So we would tell people through the planning stage, think through a bunch of issues like capital, with the capital requirement, the revenue impact, the cost impact, the working capital impact, the debt impact. Will there be any impact on income taxes? Maybe you'll incur a loss in the first couple of years and accrue some net operating losses and be able to use that to shelter some cash tax in the future years. Let's ask those questions. And the point is, if we then if we incorporate the organic opportunity into our existing model, then we can even build a switch, and we teach people how to turn a switch. You can turn it on and off. Say, do we want to look at this opportunity or not? Should we include it or not? But at the end of the day, if you do it well, it'll allow you to tell a story, and you will be in the best position possible to make the best decision as to whether you should proceed.
You know, you put quite a few things in there. I'm just going to summarize a few that I was noticing as you were sharing that. First thing is what we want to do is realize that in the forecasting, we do not expect month 1, month 3 to necessarily be profitable. We've got to actually project out some type of expected growth, and it's not this hockey stick that we're going to expect. Too often what I'm trying to express is that the business owner expects success too soon.
Yep.
And so that's one of the things that I always want to point out. Second thing, and I don't know that you mentioned this, but I find it very important, and it's determining the break-even analysis.
Yes.
Where is that break-even? When is it that we're going to achieve it? And what's it going to take? And that's our first milestone. What is it that we're working towards so that at some point we're no longer losing money? And that break-even is very key to this pro forma or this forecast that we're creating. And then afterwards, it's then how quick is it going to be to recoup the losses we incurred starting this whole venture? And one of the things that we want to do is for the business owners say, you're going to lose money this long, we're going to break even here, and it's going to take this long to make everything back that we were losing. So all of a sudden that break even isn't a profit moment, it is a we're no longer losing money moment. And so if those 3 narratives can be pointed out, I find that the business owner can see, okay, here are the milestones that I'm trying to shoot for. Here's when I feel that I should be getting out of losing money and break even. Here's when I should be able to make everything back that I've lost. Here's where I start making money. Yes. And those timeline moments in the forecast are very, very, for the business owner, very, very palatable. They are real to them. That's what I wanted to know. Here's something that I also wanted to kind of get your input on. It's best practices. Mm-hmm. I'm just going to share with you what I've done as I've been doing modeling and see if you can add any best practices. The first thing I try to do is using the historical, I create a month or a quarter where I actually use all of the numbers, the dynamic numbers, the formulas. Yeah. And what I try to do is I try to, using that formula, mimic the past 12 months. And I want to see do my formulas hold true. If my formulas hold true, I should get, if not close, the same numbers I got with the actuals that I have in my past. And that shows that my model at least is using correct assumptions. And then after I've seen that if I put in the quantitative numbers and they turn out to, in the forecast, produce the same results, then I'm like, okay, my model is true because I've just experienced it and I've duplicated it with formulas. Now, formulaically, I'm going to take these numbers, change the quantitative numbers moving forward, and I'm going to see what kind of growth will cause the numbers to change. What am I forecasting is going to be different than the past? And in my experience, that's where I get the confidence in the formulas I'm using.
Yes.
And then I can go out months, I can go out quarters, I can go out years, and I can do so with a good deal of confidence in the formulas I have. But that's just a quick little best practice that I've used. Give us some best practices when it comes to doing this this modeling.
Sure. So first of all, I like the suggestion a lot. I think it's a very clever. The only thing that made me recoil one teeny bit that you said, because basically what you're saying is you like to validate. You're building a forecast because we know now modeling is all about the future. And so what you've said is you want to make sure that your model, you want to do a stress test and validate your model by essentially putting historical assumptions in to make sure that in the future you would end up with the same results. And I would say, and then you said something like that helps you validate the assumptions. So what I would just say is, yes, I love what you do. That helps you validate the mechanics. To me, that helps you validate that the model is mechanically working correctly. Because if you use the same sales volumes and sales prices and operating costs that they had last year, remember, historical data is dead. I never suggest that people when a client gives me 3 years of historical data, I just type it in. I always tell people there's no need to recreate the formulaic accuracy of the historical numbers. I mean, it is what it is. It's never going to change. It's dead. But when I forecast into the future, I like your idea a lot. If I'm going to if I enter in next year the same sales volume as we had last year and the same price we had last year and the same headcount and the same salaries and so on and so forth, and the same interest rates and et cetera, et cetera, et cetera, I should end up with the same revenue, the same EBITDA, the same earnings, right? So that would allow you to prove that your model is mechanically working correctly. And then you can say, okay, how do we develop the assumption? Now, it's funny you talked about best practices. I actually have a webinar. I don't know if there's ever any interest, let me know. But we have a webinar that we've been leading all over the world, literally all over the world. It's been very popular. It's a 90-minute webinar. It's called Financial Modeling Best Practices. And in fact, if people go to our website, fminstitute.com. Actually, I'm not even sure if it's up there yet, but we have a version that people can sign. It's a free webinar. We don't charge for it. We're just trying to build awareness. And I go through my favorite top 10 tips to help people build best-in-class, world-class financial models. So I'll touch on in 2 minutes a couple things I cover on. I mean, planning is key. Planning is so critical. If you ever just dive right into a spreadsheet, it's going to be a disaster. It's going to be a mess. It's got to be planned and organized. We provide people with a very specific 3-step planning process, so you know exactly how you should plan a model. I always tell people to keep the assumptions up front in your model. So have one sheet in a spreadsheet that has all of your assumptions, things like your expected sales prices, your sales volumes. First of all, and this is a good modeling best practice, is to use a couple different colors. Hopefully you do this as well, Roger. So for instance, any number that you ever type in, if you ever type a number into a spreadsheet, it should be blue. Then the font number should be blue, whereas anything that's a calculation in a spreadsheet should be black. Why? Because that way, when you email it to someone or when you want to make a change, you know immediately which of the cells you can play with and which are the ones that will calculate on their own. So we always tell people, have an assumption page, put all your assumptions on the one sheet, label them nicely, make them look beautiful in categories, because the assumptions come out of the planning. That comes out of your thinking and planning. So it's nice to keep all the assumptions up front because that's how I can communicate the story to you. And then one other tip is here's one where people go wrong. I often encourage people, there's really only 2 ways to actually construct a model, and we refer to vertical orientation and horizontal orientation. So as an example, I'll give you a simple one. One way you could construct the 3 sets of the 3 financial statements, I'm sure you've seen this, Roger, is on 3 separate sheets, 3 tabs in a spreadsheet. Have you ever seen that? You have an income statement on the income statement sheet, and then the next sheet in your Excel spreadsheet is the cash flow statement, and then the next sheet is the balance sheet. That's what we call horizontal orientation. The other way to build models is through a vertical orientation where all of them are on the same sheet stacked on top of each other. My recommendation, and because we see much fewer mistakes, would you care to guess which one leads to a lot less errors? If you had to guess, Roger, which approach do you think would be more efficient, do you think?
Well, I'm going to take a guess. I'm going to say the horizontal. But you're probably going to say the stacked because it's all on one page. Yeah,
so horizontal is very common. Horizontal is probably the more common approach. And why is it more common? Because naturally in people's heads, they think of a sheet as a piece of paper. They think,
it's compartmentalized, right? Is why.
Exactly. Yeah. They think, I should be safe. I should put my income statement on one sheet and my cash flow. And when you ever ask people why they do that, they think, it just makes sense. I can keep. So I will tell you, Roger, one of the number one reasons why Excel spreadsheets become a disaster, too many tabs, too many worksheets in the file. Because what happens then is the formulas are constantly cross-linking to different sheets. It becomes impossible to track what's going on. People get lost, mistakes get made. Our strong approach, which is often very eye-opening to people, is to say, no, try modeling vertically. Put them on top of each other. And you need to make sure that the same time period is the same column for the income statement. Because what happens then, because you know this as well as I do, in any company in the world, their financial statements talk to each other. Right? Income statement starts with revenue, drives down to net income. Well, what's the very first thing on a cash flow statement? Net income. And if you keep them vertical like a waterfall, the net income on the cash flow just simply links up and you can easily build it, you can audit it, you can check it. So simple. Cash flow statement adds back a bunch of items from the income statement. It's so easy to see. Cash flow statements always end with ending cash. Well, where does that go? That becomes the first line on the balance sheet. It all flows down a sheet vertically, and we see so many less errors and much easier to audit, build, and make sure things are working when the financial statements and many calculations are designed vertically. Now, it's not always intuitive, but it makes it much more straightforward and easy to use. Now, in the webinar, people sometimes worry and ask questions that then a sheet might get very long. We have some great navigation tips to help people jump around, but design is critical. And I will tell as a takeaway for today, a vertical orientation, try it. Don't be scared of it. It actually leads to simpler models that have less errors typically.
Well, I like your suggestion because I'm going to add a few more things to it to substantiate what you're saying or complement rather what you're saying. And it's basically one, when you're doing it on a single sheet in the stack format that you're describing, the beauty of the formulas is when you click into the actual formula in the address bar, it actually shows you all the cells that are part of that equation. Well, if you've got the equation jumping from tab to tab to tab, you're not able to visually see that. So you click in there and you can quickly go through and see, oh, these are the cells that are being used in that calculation. The second thing I like about it is how you were building. You're using the numbers, how do I want to say this? You're duplicating the numbers less often. The number that you were saying, for example, the revenue can just be a single cell. It doesn't need to be 3 cells throughout different tabs. It's one cell, and you're just able to draw from that single number. And as it gets changed, it just impacts everything else. So I like that in the simplicity format. The one thing that really stood out to me, though, was the idea of using colors. I also use colors. I will highlight certain cells, certain colors, and then I'll put a key, and I'll say in the key, this is what these things mean. The highlighted cell that's yellow, the highlighted cell that's red, the red number, the blue number, as you were describing. I provide that key, and that key basically says to things. And then if you're really strong in your skills, you can actually block certain parts of the spreadsheet that they can't change things.
Correct.
So all of a sudden, you're eliminating some of the errors where somebody gets in and deletes a formula and puts in a hard number, or they change something. It's like, what did you do? Please don't touch this. And it's by blocking that and leaving them areas that they can then manipulate. So good things. Here's a question. Odd question, but very valid question.
Yeah. What
if your balance sheet isn't balancing with all this? I mean, the balance sheet does come into this.
Wow. Yeah, I love that question. I have another webinar. Because modeling has become such a critical skill set, and literally it's around the world. It's global. I mean, we have been running webinars to groups in 40 or 50 different countries through professional societies and sharing what we're doing and sharing these skills. So as I already mentioned, one of them is on skills to properly design and organize, top 10 tips on modeling best practices, but another one is on what to do if your balance sheet doesn't balance. And I share with people my favorite top 10, because I've built 100 models. I've probably looked at thousands of models from many of my students, and I distilled down, I mean, I can't go through all of them right now, but I've distilled down 10 reasons, top 10 reasons I have found models don't balance and balance sheets don't balance. I'll try and share a couple of them with you right now. What I would say is what's never allowed, with the biggest no-no that we would ever encounter. It's a 4-letter word. I hope I'm allowed to say it. No plug. You cannot have a plug on the balance sheet. No plug. And of course, a plug means that you've built the entire balance sheet except one row. And people say, oh, it's the debt row or the equity. It doesn't matter. It's any row. You build a whole balance sheet and you leave one row blank. Let's call it long-term debt. But it doesn't matter. It could be any row. It could be cash. Could be taxes payable. It makes no difference. You build the whole balance sheet except one row. And then the way people build that final row is they back solve. If it's debt, they'll say, well, equals. They'll say, take the total assets minus all the other liabilities, minus the equity, and that's what backs them into their debt number. That's called a plug. And everyone gets excited because, hey, balance sheet balances. The balance sheet guaranteed will balance all the time. The problem is when you plug your balance sheet by back solving it, it will guaranteed balance all the time, even when there's a mistake. So even when there are errors in your model, even when there are mistakes, it will still balance. So it's really dangerous. We tell people you should never, ever build a plug formula directly on your balance sheet. The model has to balance the balance sheet has to balance without a plug, because that proves that the mechanics are working properly. So what are some of the most common reasons balance sheets don't balance? Well, very honestly, this is going to sound silly, but just simple arithmetic. Sometimes we'll look at the total current assets row and it didn't pick up all the lines. They will have excluded the inventory or they have excluded cash. So sometimes it's as simple as the totals are not picking up the appropriate lines. Can I tell you? Well, I'll tell you one more. Another crucial reason why model balance sheets don't balance is sign issues. There are a lot of variables in modeling, in accounting, where the sign has to be positive in certain instances and then negative somewhere else. What am I talking about? When I think about the capital spend, the annual CapEx budget, the capital spend budget, that represents the value of new assets that we're planning to purchase over the next few years. If I'm going to be building a new gym, I might spend, $500,000 or $1 million on new equipment in over the next 2 years. So on my assumptions, I would say my capital expenditure forecast is $500,000 in the first year, $500,000 in the second year. And those are positive numbers because they're going to make my PP&E, my fixed assets, go up. So they're positive in that spot. But on a cash flow statement, of course, they have to be negative. They have to reflect an outflow of cash. And it's amazing how often people will get the sign wrong and they'll show the sign in the wrong way. Same thing with a debt repayment. Same thing with a dividend, for instance. Dividends show up as positive numbers when you're talking about, the common equity account. That's my dividend is $1 million, but it must reduce retained earnings and it's got to show as a cash outflow on a cash flow statement. So huge issue on models is that some items like working capital, dividends, CapEx, people get the signs wrong. And then as a result, the balance sheet doesn't balance. So those are a couple, but to start off on today's podcast, but there's reasons like that. They're always pretty simple reasons, to be honest.
Yeah, the whole stack philosophy, having the formulas so that you can, in a single sheet, see where the formula is actually pulling from which cells, the positive, negative, as you were saying right there. But I'm going to add one more. The most common thing I've found is too often when they're using the formulas and they're like on a forecast going from month to month or quarter to quarter, they're dragging over the formula and they're not realizing that they didn't put the dollar sign in front of the row or the column. And so they drag the formula across, not realizing that it's fixated on or not fixated on the cell they intended it to use for the variable. And it just messes everything up and they don't catch it until later on. And so that's the easiest fix and the most common thing I've experienced. So that's one of the common ones there.
That's what we refer to as absolute versus relative referencing. And it is, again, a crucial issue. Absolute versus relative referencing in spreadsheets is a critical skill that's needed, to get them working properly.
Exactly. No, it's all about that mechanics that you were talking about earlier. All right. So here's the thing. What is the most misunderstood thing of what it is you do when doing the modeling? Probably
the misunderstood thing is the notion that modeling is a very technical, esoteric skill, as I said, that requires some sort of a numbers geek to sit in a corner and build some sort of a tool, when in reality, modeling needs to be a front-facing, ubiquitous skill. It's a multidisciplinary skill that a strong financial modeler is so much more than just a technical person sitting in the corner. They're the leader of any process, of any project. They are the central. Think about this. How many people, think of a medium-sized or large company, how many people at any company truly understand all aspects of the business? Very few, right, Roger? In larger organizations or mediums, you have a person who's responsible for, AR, and a person who's responsible the income tax people and the sales people and the marketing people, and you have everyone has a specialty. There are very few people at any company who truly have a global, multidisciplinary understanding of the whole picture, right? Of the whole process. But the modeler has to be that person. The modeler is someone who sits right in the middle and understands how a decision around revenue is going to impact volumes and manufacturing issues, and it's going to impact the hiring needs and the labor and working capital and debt. So the modeler is right in the middle. The mix has to be a great communicator and has to be able to tell a story and to be able to, put their foot on the brake and the gas to help provide warnings and to help make sure that we get great insight into any opportunities in any business. And so, yeah, the big misconception is that modeling is often thought of as a very technical field. There is a technical component. It's so much more than that. It's about being a leader at any organization to help make optimal decisions.
As you were describing how this person, the modeler, needs to understand so much of the business, I can't emphasize that enough. There's probably no one more suited, other than perhaps upper management, perhaps even the owner or president of the company, that is as fully aware as that modeler, because they have to understand how all of those numbers relate to one another and how they are dynamic. And so in order to build a proper or very robust modeling, they have to have that familiarity with the entire business model. So well said there. So I'd like to get a story from you. How has modeling actually helped a business? And give us a story of how it was so helpful in either avoiding a failure or achieving a success.
Yeah, great. You mentioned in my bio earlier that there's a business I started 20 years ago called the Marquee Group, which does training and consulting in the field of modeling. We build models for a wide range of clients. We teach programs and we build models. So we've built models for a wide range of clients in order to help them make really effective, powerful decisions. There's all sorts of tools we have built for companies. I'll give you an example from a bank. We were doing work with a very, very large bank, and they were looking to remove paper, from the process. Think about this. How much do you think, take a guess, what do you think, think about a mid-sized bank, how much do you think they spend on paper every year in statements? All the statements they mail out to their clients, monthly statements on their checking accounts, their savings accounts. They mail out paper for their Visa statements, their MasterCard statements, all sorts of mortgage statements. So the bank spends, well, I won't have it different by bank, but this bank we were talking to was spending $150 million a year on paper. Okay. Now that included the paper itself, along with postage, along with the printing fees and whatnot. But there was a lot. So of course they were motivated to move to electronic, right? So anytime people would log in, they would say, "Would you agree to switch to electronic statements?" Because of course, if you receive your statements by email, saves a lot of money for the bank. So they were hoping to be able to bring that cost down from $150 million down to by half over a few years. They had a bit of a tool, but it really wasn't very helpful. They were going to deploy some marketing dollars to see if they could encourage changing people's behavior and what would it take, but they weren't getting very good insight into what that would do and what the correlation would be. So we built them this beautiful tool that's used past data and said, listen, if you do X, Y, and Z, this should be the trajectory to allow you to get adoption at these levels and give you a bunch of switches and levers to say, what if we do this? What if we do that? And to let them have visibility and to know what could be the reduction in paper cost, how to get from $150 million a year down to like $75 million. And what would it take to get there? But most importantly, we gave them a narrative. We gave them an ability to go to senior management and say, here's what we need to do. And we do this, this, and this. This is what the likely outcome is. And this should allow us to bring our paper cost down by $50 million a year, or whatever it was. And everyone had confidence to buy into that. And I could go on for all sorts. That was just an interesting one because no one ever thinks about things like that. But that's the kind of decision making. That was a project-based model. But gosh, we help all sorts of companies build tools to evaluate the whole business so that they can make all sorts of critical decisions.
Well, the story I'd add, and thank you for sharing that, because I think that is a good example of how the modeling can be so helpful. But in two examples that I have working with business owners, when I'm working with my clients and we forecast the coming year and so forth, one of the things that I have found is when I can put in front of them the numbers that they're familiar with, that show that the decisions they're interested in making for the coming year, the changes, the rollouts and so forth of a new marketing strategy, a new product line, if I can show in the forecasting that this is what numerically this is going to do to the bottom line,
right,
all of a sudden they get excited. It, yes. It validates their decision of, this is what I'd like to launch. This is what I'd like to do. And I feel that the business owner gets that validation they're looking for to say, okay, I can move forward with confidence.
Yes.
Because even if I miss this mark, it's at least something that I want to achieve and accomplish, and I'm going to move forward because it's not just me thinking and wanting, it's now
100%.
numbers substantiating what it is they intended to do. So I've had numerous successes with business owners where we're able to forecast out what the coming year may look like with some changes and variations, and they get excited, and it gives them the confidence to work through some of the challenges that they face along the way because they have an end goal in mind that they can see on paper. The second thing that I can share is I've had instances where, for whatever reason, the business model was not sustainable.
Right.
And the business owner realizing, you know what? At the trajectory I'm going here, the trajectory is going to be continual loss, and I'm going to get into a hole. And if I don't turn this around, this is the wrong direction. And it gives them confidence to say, you know what, maybe this is the time to bail rather than 6 months from now when I've had 6 months of continual losses. Maybe I just need to cut my bait today and stop the insanity. And so I've had instances where even in my own company, we've closed divisions. We've actually let people go, and we've moved things around to leverage talent in other areas of the company because we could see that the end had come for a certain division of the business. And it was through forecasting that we had the confidence to know when to pull that trigger. Otherwise, I think too often we are, in many ways, as optimistic entrepreneurs, we go into situations thinking, it'll get better. What we used to experience will come back. And in reality, we've got month after month to say that it's getting worse and getting worse. We've got to end the insanity. And so the forecasting enables that confidence to say, you know what? All this is doing is projecting failure. There's no way to turn this around. I've got to cut bait, and this is where I'm going to do it. And so I've had numerous successes with forecasting that have been very helpful with my own clients, and I think that's something that I wanted to add to that. All right, so I'm going to end with one last question.
Yeah.
With your experience, what is the biggest challenge accounting professionals face as they consider offering forecasting services, modeling services within their business for their clients?
Great question. I would say the biggest challenge is that modeling is not accounting. It's a different skill set. Modeling is a multidisciplinary skill set that includes accounting. Accountants have a leg up to learn modeling because accounting is one of the 4 or 5 skills needed to be a good modeler. They need to recognize that just because we're using the same language and we're using the same words like debt and working capital and costs, it's a very different discipline. The idea of creating accurate historical financial statements and reports and tax filings, that's a very, very different skill and offering than helping a company think through the future. So an accountant needs to recognize that they have an understanding of the language. They are well positioned to learn modeling, but it's not a given and it's not obvious. And regrettably, sometimes I'll have to tell you, some of the worst models we've ever seen have been built by accountants because some of them think, well, I'm an accountant. I should know everything I need to know about modeling. But the number one reason why models fail is not because the person lacked accounting knowledge. The number one reason models fail is because of poor design, because they didn't understand design concepts and design constructs. So an accountant needs to recognize that there's an opportunity to take their existing knowledge, layer on modeling skills, and then the service of offering modeling could be one of two things. It could either be building a model for a client that they use, or it could be coaching them through it themselves and being the sounding board to say, are you sure about that? Does that really make sense? Or you need to factor in 3 more people, right? To be someone who has the confidence to push back and challenge and provide guidance. Because, it's good for companies to have the skill in-house as well. So yeah, I recognize that it is, there's a lot of elements to modeling. You need really strong Excel skills, strong design skills. You need strong understanding of business and business levers and accounting skills. And if you have all of it, then you're in a great position.
Wonderful. I like that summary of the different things needed to be a good modeler. I'm going to add to it one other thing, and it's being able to ask the right questions.
Yeah.
where accountants can sometimes struggle is they're just not asking the right questions of the business owner as to how the model needs to project what they're intending to do. And so it's asking a lot of questions to understand what are the changes they're foreseeing within the business so that they can financially illustrate those. And one thing that I don't think we had enough time for, but I do want to emphasize, is it's the visual representation of the end product that's also so key. When you're delivering this, if it's just financial reports and numbers, too often they're just seeing the same thing that they see from the historical data that just doesn't make sense to them. And so they just want to ask, at the bottom line, is the net profit positive? And if that's the case, okay, it sounds good. Sometimes the modeling needs what you're saying, that illustrative, that graphic element to be able to communicate the information in a compelling way. Yeah, you've used that word a number of times. So it's not just the numbers, it's also the delivery of that for the business owner to get excited about what they're looking at. So very well said. So here's what I'm going to do. I'm going to summarize a few things here, and then I'm going to come back to you, Ian, for just a closing thought. But as a summary, I want to invite all the listeners to the episode description. There you're going to find some things such as the offer that Ian made. He has 2 webinars. One is the best practices. The other is the top 10 reasons why balance sheets don't match. We're going to put those there for you to have access to. But in addition to that, what I want to do is I'm going to put some information for you regarding becoming a profit and growth expert. And it's literally becoming more of this advisor, having that relationship with your client where you're going beyond just the accounting. And it's an excellent addition to the quality accounting services that you're offering when you can take on that CFO advisor type role and have a much more trusted relationship with your clients. And it would involve, obviously, this very thing of forecasting so that you can really get more into the future of what the business is experiencing and help the business owner answer those questions of what if. And that's where I think you're going to find a lot of resources of value to you. So check out the episode description for those additional resources and take advantage of those and see what it is you can do to maybe bring into your business model and as an additional service, a new revenue stream, this idea of modeling. Now, with that being said, the other thing that Ian is also providing to us is he does offer the ability to become certified as a modeler. And so if you go to the episode description, you can actually find information to become accredited as someone in financial modeling. And it's where you're now an advanced financial modeler. And in such, you can get 10% savings on his offering to, in fact, get trained as a financial modeler. Now, with that being said, I want to do a summary and just point out that modeling is, to me, fun. It basically takes what the business owner is trying to envision in their business, what they're hoping to accomplish in the coming future, the months, years, and such, and putting it down in a number that we can understand, and from those numbers find places where there might be stresses in the business model, cash flow, maybe staffing, maybe inventory, and we can start bringing our expertise to that business and help the business owner maybe avoid some of the challenges that they're not foreseeing as they're excited about the growth that they're planning for. That right there helps us now play a part in the business beyond just reporting the historical numbers. So I like how Ian helped us understand that this has a place and there's a method to it. There's a strategy. I love that stack philosophy of using one sheet to actually compile all the data. He gave us some tips and tricks on using numbers such as blue numbers, black numbers, color coding things so as to help at a glance see what's happening with the numbers that are going on. All of these things make huge impacts in what it is you're creating as you're modeling out that business's forecast. Now, with that being said, I also want to just add, I love Ian's energy for this. One of the things that we just talked about at the very beginning is, as instructors, one of the things we have to bring is our own passion. And that's what's contagious for our listeners, and that's what's contagious for the students to get excited about what we're talking about. And he's done just that, and I appreciate him bringing that passion to today's conversation. So, Ian, with that said, what would you like to add as a final thought?
Well, first of all, thanks. I really want to thank you for having me on your show. It's been a real thrill. It's always a thrill to meet fellow accountant. Well, I'm not an accountant myself, but fellow people that are modelers, that are in the space, that are trying to help small businesses. And you bring a great energy as well. So thank you for having me on. It's been a thrill to be here. Hopefully I'll see you again. I would just reiterate, that modeling is so much more than accounting. It is a discipline. And we're trying to help educate people all over the world that modeling is a discipline that requires a lot of different skill sets, some finance, some accounting, some design ideas, Excel. And we're trying to build a tool. Again, people often think of spreadsheets as, I want to change people's mindset that a spreadsheet is not some horrible, thing that should make you uncomfortable going in, but rather it's a strong modeling skills allow you to build a beautiful, clean tool that ultimately will help your clients and yourself make optimal financial decisions. And the very last quick thing here is we're in a very interesting time. As you know, and your listeners know, we're in one of the most unusual times in the history, in modern history with regards to businesses and business valuations. Valuations are through the roof. Businesses are worth more today than ever before. Valuations make no sense, which means that anyone listening now surely has clients more than ever saying, what's my business worth? Should I think about potentially selling? More than ever before, people are saying, should I sell my business? I heard my neighbor sold their business for some absurd price. Does it make sense? And having a strong forecasting tool and a strong model will be a tool that can also help think through what could valuation look like, which is a question that all business owners are wondering about these days. And to be able to provide some guidance on that, extremely valuable.
Exactly. We need to play our part as accounting professionals in helping with exactly that. So that is a perfect end to today's discussion. So with that all being shared and said, let me encourage you to become, exactly as Ian mentioned, a advanced forecasting modeler and do your part as you work with your clients to do what they need to basically plan and get excited about their future. I also encourage you to listen to our other episodes and subscribe to the podcast where we have so many of these experts coming on to share with us what it is we can do in our business to in fact be the premier accounting firm in our area. Now, for more information on how you can apply these principles in your business, please visit us at universalaccountingschool.com or give us a phone call. You can reach us at 801-265-3777. And always remember this, if it's about accounting, it is universal. Take care and have a great day.